Live from Bloomberg's world headquarters in New York, I'm Scarlett Fu.
And I'm Tim Stanovic. Welcome to Bloomberg Crypto. It's a look at the people, transactions, and technology shaping the world of decentralized finance.
Bitcoin is bouncing back, extending its recovery a week after we saw billions of dollars of value wiped out in digital assets.
In just a moment, we're going to speak to Brian Brooks. He's deeply involved in various crypto boards, including strategies. He's also CEO of the real estate firm Meridan. We discuss the cross-section of digital and hard assets.
We'll also be speaking with the CEO of ACI Worldwide, the traditional payments player, discussing the new world of stablecoins.
That's all ahead on Bloomberg Crypto over the next half hour. First, though, a check of the market. As Scarlett mentioned, we're seeing a little bit of a bounce back for Bitcoin, at least today, up 2%, $2,400 to $113,500. But to really understand the full story of what happened over the last 10, 11 days, we really got to zoom out and look at what happened back on Friday the 10th. Remember, Bitcoin's lost about $600 billion since the record crash on that Friday, October 10th. That volatility was partly set off by tariff concerns from President Trump. Look at this. Went from about $122,000 on that day in a very short time down to $109,000. Recovered a little bit, and then last week crashed further, hitting a low of around $104,000 before recovering a little bit to $113,500 where we are right now. But Scarlett, we got to remember, Bitcoin's still up close to 20% so far this year.
Yeah, long-term context, right? Let's also take a look at the price action for other coins. It's not just Bitcoin. You look at altcoins, they have seen even bigger losses. Billions of dollars in value disappearing over the past month. Some tokens have tumbled 70% this past week. The crash is really raising concerns about the disconnect between regulatory approvals and investor protection. There are currently some 130 ETF applications linked to altcoins under review at the SEC. But Tim, we know the SEC shut down at the moment.
Well, decentralized exchange Hyperliquid has come under the microscope during all of this volatility. It's drawn heavyweight investors and billions in trading volume in just 2 years, with monthly volumes above $6 trillion. Last month, we caught up with David Seamus from Atlas Merchant Capital, who will be the CEO of Hyperliquid Strategies. It's the public company that plans to hold Hyperliquid tokens.
So basically the way to describe it is an exchange like a Coinbase, but it's also its own layer one blockchain like Ethereum or like Bitcoin. And it has allowed them to build an exchange that is very sleek, that is very efficient, that you can trade really efficiently with a lot of liquidity on, but it also has allowed them to create an ecosystem that others can build on top of it.
Bloomberg's Muyao Shen wrote a feature piece on Hyperliquid, and she joins us now. Muyao, you heard what David said. Hyperliquid is an exchange comparable to Coinbase, but how is it different from Coinbase? How is it different from Binance?
Yeah, for sure. So as we all know, Coinbase and Binance, they are crypto exchanges sort of similar to a traditional stock exchange. They hold customers' funds, they match orders internally, and they also do KYC requirements. So you know who's trading on these type of exchanges. But Hyperliquid is quite different in that way. So everything runs on Hyperliquid is on the blockchain, thanks to smart contracts, which are pieces of code that runs on the blockchain directly. So everything runs automatically, like on the blockchain. I think that's also why you have like thousands of people running business at Coinbase or Binance, while the core team runs Hyperliquid only has about just 11 people.
Some of the numbers, Muyao, associated with Hyperliquid are just staggering here. It's drawn heavyweight investors and billions in trading volume in just 2 years. Monthly volumes above $6 trillion. What has made it so successful?
I need to double check the number on the monthly trading volumes, but I think there are a couple of reasons that make Hyperliquid super successful. So as we said, usually exchange requires a KYC process. And I think Hyperliquid, because it runs on the blockchain directly, as if you know the right access to it, you're able to trade it directly. So, I think that's a huge benefit of that, right? So you don't need to go through the traditional KYC to trade on Hyperliquid directly. So when a lot of exchanges like Binance was facing a lot of regulatory crackdown a couple years ago, people can still go to places like Hyperliquid to trade there. Another element make it super successful is that, don't get me wrong, I think what they're building is nothing new. So on-chain crypto exchanges, there have been like previous efforts like DYDX and GMX, for example. But I think what they failed to achieve is both being extremely fast and also being able to have this deep liquidity that's required on crypto exchanges. And Hyperliquid is able to achieve both.
Muya Shen of Bloomberg News. Check out her feature all about Hyperliquid. It's on the Bloomberg terminal and at Bloomberg.com. Well, let's bring in Brian Brooks. He's chairman and CEO of the major commercial mortgage broker, the Meridan Group. He's also on the board of directors of Strategy. He's the former CEO of Binance US, former US acting comptroller of the currency. That's just a few of the things that he's done in recent years. It's good to have you on Bloomberg Crypto, Brian. I just want to start with getting an idea of how things are going at Meridan. You've been in the position since March of 2024. Where are you in kind of getting things under control?
Well, it's a great question, and thanks so much for having me, Tim. I really appreciate it. Meridan is going great. It's one of these things where you had a giant company that was really the dominant platform in its space, and it ran into a couple of regulatory hurdles. Your crypto viewers will recognize this from lots of crypto companies. Meridian's a traditional finance company, but the story is the same. You grow at a hyper growth rate. You have a handful of people who didn't get the compliance memo, and somebody's got to come in and impose some set of controls. So the markets are coming back. You see it with Bitcoin, but you also see it with commercial real estate. And as the animal spirits return, we're in the market. We're feeling terrific. All of our restraints have been lifted. We're back doing business like it was 2022 again.
Brian, Tim gave you an introduction and he cited all your titles. You wear a lot of different hats. How do you wear so many different hats, balancing these different jobs from traditional assets like real estate to the crypto space?
Well, it requires having a philosophy, and I'm going to just quickly tell you what that is. So to me, this idea that there's a distinction between traditional finance and digital assets is based on sort of 5- and 10-year-old thinking at this point. The truth of the matter is everybody who's in financial markets is looking for the same thing. Everybody's looking for yield and price. And whether you're finding that in the commercial real estate markets or in consumer finance or in equities or in crypto, everybody's looking for the same thing, which is rates of return. And at a certain point, all of those distinctions between those asset categories collapse. I would just pick up on what you were just talking to David Seamus about a couple of minutes ago. This is what makes Hyperliquid so special. Liquidity is just seeking yield. The company I run is one of the places where it seeks yield, and there are lots of other places, and we should stop making these artificial distinctions.
I want to take a step back and just get your comments on the industry right now and the growth of digital asset treasury companies. I'm curious about, obviously you're kind of involved in the OG DAT, which of course is Strategy. And I think since then, it's fair to say we've seen quite a few copycats, not just with Bitcoin, but with other assets as well. Lots of questions about DATs right now, whether they can hold up in the long term, whether their ability to raise money to invest in crypto is working out. Is it working right now? Will it continue to work?
Well, I think it can continue to work, but I think one of the issues is, like in any gold rush, a lot of people looked at what Strategy did and they said, oh, I can buy a lot of Bitcoin or a lot of altcoins as well, and if I hold it, I'll trade at a premium to my net asset value. That's not the way it works. That's not what worked for Strategy, and for the handful of other companies that are succeeding, that's not what they're doing. The purpose of a digital asset treasury company is to be able to engage in structured financial products that the market wants. It's not just buying spot crypto and holding it in a treasury and expecting somebody will pay a premium to what they could buy that same asset at Coinbase on. So what I mean by that is, if you have a company that has enough liquidity that they can offer you a futures product or a short product or a hedge product or a collar product, all of a sudden the reason that digital asset treasury company is making money isn't just because it holds the assets. It's because it can convert those spot assets into slices of exposure that add value to certain investors relative to just buying Bitcoin at Coinbase. That's, I think, the piece that people miss.
Okay, so it's the value add that these DATs would provide down the road, not the fact that they're just yet another DAT. What is your single biggest concern about the proliferation of DATs?
Well, my biggest concern is that you have one or two spectacular failures and then people throw babies out with bathwater. You saw this a little bit with the Nakamoto project, the David Bailey project, which I think had great intentions and was pretty well executed, but it missed this one core insight, which is if you don't have the liquidity to do what Strategy did, if you don't have an ability to offer, for example, a short product, a derivative product that looks a certain way, something that offers value to investors who don't want to own Bitcoin but want Bitcoin linked exposure, you're going to crash and burn. And so the worry is you have one or two bad apples that cause the whole model to be thrown out. You've seen that in a lot of other sectors of crypto. You're going to see it here too.
Hey, Brian, we don't have a ton of time, but there's really a lot we want to get to. So I want to move on to tokenization and the idea of tokenization of real world assets. We've been hearing a lot about this in recent months. Vlad Tenev has been pretty open about tokenizing private companies so then more investors can actually get access to them before they go public. I'm wondering from a real estate perspective, there are a lot of people who are not convinced that this is necessary. Convince me, convince them that real assets should be tokenized.
Well, I mean, I would start with the idea that the number of people who are able to participate in the financing of, for example, a landmark office tower is very small. Typically, the only people who can do a deal like that are big firms like Blackstone or government enterprises like Fannie Mae. And those projects turn out to be very profitable. They're great investments, but you and I are mostly not able to invest in them because of the nature of the market. You know, the ticket size to invest in something like that is in the hundreds of millions of dollars. So the question is, why do we let people buy stocks in tenths of a share units, but we don't let people buy real estate or real estate loans in those same kind of units? And what would happen if you created a much broader liquidity pool for something that right now may only have 10 or 15 global institutional investors? The idea would be you'd have much faster price discovery. You'd have more democratic capital formation where regular investors like you and me might be able to participate. All of that would be a great thing. We don't have it right now because we don't have the financial plumbing to allow that to happen. And that's what tokenization is all about, is if I could buy, you know, a contract on the value of houses in my neighborhood, for example, that would be an easy way for me to get exposure to residential real estate without having to have $1 million to buy a house. But that product is only coming to the market today. So I actually think there's a huge future for this, real estate being a great example, but not the only example.
The other thing that we've noticed, of course, in the industry is crypto companies applying for bank licenses. Anchorage Digital, Circle, Ripple, each have made their own moves. What do you make of that? Why do they need them? Is there a common thread, or is each going for their own reason?
Yeah, well, I would make a couple comments on that. There's why they need them, and then what should the incumbent banks worry about that happening? The reason they need them is because there's certain powers that come with having a bank license. You can take deposits. You can perform fiduciary activities. You can operate across state lines if you're a national bank. There are all kinds of things you can do. And you can't do those in any other corporate form. There's no other license that allows you to do that. So it's a great tool to have. By the way, you listed some of the companies that are in the bank application space, but not some of the biggest. Coinbase has filed an application for a bank charter. BitGo, which I'm on the board of, has also filed a bank application. There are like 25 crypto-related companies applying for bank charters right now, and with good reason. They want the same powers that JP Morgan has. If I were looking at the space, I'd be more worried if I were JP Morgan than if I were one of these crypto companies, because historically the biggest banks have said, we own the payment system and we own the deposit system, so we're unassailable, and we don't have to touch some of these newfangled digital assets. But the worry is when the most scale digital asset companies get bank charters, you flip the script and all of a sudden they'll be able to offer a range of banking services plus digital assets that the incumbents aren't able to do. So my belief is, coming back to my point about collapsing these distinctions, these bank applications are the front end of these distinctions starting to collapse. It's all liquidity, it's all seeking yield, and it's going to happen inside of those kind of charters.
Yeah, well, flipping the script is very much the MO of the crypto industry. Meridan Capital's Brian Brooks, really appreciate your joining us today. Thank you so much. Coming up on Bloomberg Crypto, we're going to turn to payments and talk about the opportunity and risks of stablecoins with Thomas Warsop. He is CEO of ACI Worldwide. And a reminder that to access all of the latest data and news on crypto, check out CRYP Go on the terminal. This is Bloomberg. This week in FinTech, the Payments Unleashed conference hosted by ACI Worldwide, which was one of the pioneers in digital payments starting in 1975, back in the day. Now with the Genius Act, stablecoins and payments have become part of the conversation, with more mainstream players considering their usage. So let's discuss this topic further with ACI CEO Tom Warsop. So Tom, where are we with actually having stablecoins part of the payment system? The Genius Act certainly nudges things along, but how far away are we from that?
Well, volumes are still pretty low, but we're seeing some really interesting use cases with stablecoin. I'll give you just two examples. One would be a situation where you have an economy with an unstable currency or perhaps an illiquid currency in terms of foreign exchange. And that's always been very challenging. Moving money in and out of those economies is very, very hard. Stablecoin takes a number of the risks and problems with that out of the equation because, of course, it's denominated in a fiat currency which is highly liquid. And then because it's completely digital, it makes that transfer relatively easy. So that's one. And then and that applies both domestically in those, let's say Argentina, just to pick one, not to pick on Argentina, but that's been notoriously difficult, and you have a lot of devaluation. So stablecoin can help solve that problem. And then the other one is real-time movement of money cross-border. And so that doesn't matter really what currency you want to use, that can be quite expensive. And the stablecoin has the potential to reduce friction, dramatically reduce cost in cross-border transactions.
People know ACI whether they realize it or not. They've used it whether they realize it or not. You power 16 of the top 20 global banks. You're the payments infrastructure partly there.
Yeah.
It works. It works right now. Why do you need stablecoins? Like, what changes if you adopt this new technology?
Yeah, exactly. I mean, this is the conversation, and I think from my perspective, what we're going to see is stablecoin will gain traction. We will see it have a larger share of payments worldwide, but I don't think that in the short term, I don't think that comes at the expense of other payment types, because what we've seen over the years is, to paraphrase Mark Twain, the death of cash has been greatly exaggerated. Because what we've seen is I mean, I've been in this business for 35 years, and 35 years ago, people said nobody's going to use cash in 10 years. Well, that's not true. Cash transactions continue to grow. Credit transactions continue to grow. Stablecoin obviously growing fast off a small base. I think it's great because it gives consumers and company treasurers and other users more options. And depending on what you need to do, you're going to pick the right payment type. And from our perspective, my company's perspective, we're indifferent to what type of payment, what payment mechanism you use. We just want to make it as efficient and frictionless as possible. And so stablecoin is a great way for many use cases. But as you said, it's working today. So if you think about the United States, if we're looking at domestic payments in the United States, I struggle with that use case. Why would you do that? Because you have real-time payments is a very low-cost, easy, instant payment mechanism, ACH, credit, debit. There's so many choices. Other parts of the world, that's not true. And so you could, I mentioned one a moment ago, so I think in other parts of the world, there will be very interesting use cases.
So you're talking about maximum optionality, essentially,
yes.
And other regions have moved farther along on this. You point out Europe as an example. They have a genuine opportunity to lead. What are they doing right that the U.S. can learn from?
Yeah, I think so. I think the European Central Bank has done a good job of promoting real-time or instant payments. Stablecoin can absolutely be used as the mechanism for real-time payments. There's other ways you could do it too, but they've pushed really hard into that. So giving the consumer, giving commercial users more optionality and very clear rules around that environment. I think the U.S. From a stablecoin perspective, the Genius Act is really driven a lot of the attention straight to the U.S. And in fact, I was talking a couple of weeks ago at Sibos in Frankfurt with a lot of players in the industry, and there was this big concern that Europe's going to be left behind on stablecoins. Because if you think about most of the press you read, it's about dollar-denominated stablecoins.
Yeah.
It doesn't have to be dollars. And the Europeans are like, whoa, we might be missing the boat. I don't think they will, because there's room for more than one stablecoin in the world. And so I think the Europeans are doing a great job on the real-time payments. I think stablecoin can add to that value proposition. I think worldwide we're going to see both stablecoin and real-time payments coming together, facilitating cross-border and low liquidity currency exchange.
ACI CEO Tom Warsop here in the studio. Tom, thanks for joining us today.
Thank you.
Coming up next, Bitcoin whales are converting their holdings into regulated vehicles like ETFs without selling. BlackRock capitalizing on the wealth transfer. Those details next. This is Bloomberg. Big Bitcoin holders are using a new generation of ETFs to transfer their wealth off the blockchain without selling. Bloomberg's Emily Grafeo reported on these in-kind transactions, and she joins us now. How are they doing it?
So the SEC approved in-kind transactions in spot Bitcoin ETFs back in the summer. This is a kind of transaction that happens in most ETFs, but basically we spoke to asset managers that have these ETFs that are saying that high net worth investors are coming to them saying, I made a ton of money in Bitcoin. I want to bring it into the regulated financial system. So what they're doing is they're taking their Bitcoin and they're giving it to the ETF. They're getting back shares of a Bitcoin ETF in return that then they can use for lending, collateral, margin, because it's an ETF as opposed to Bitcoin holdings that they had like in a cold wallet.
So TradFi to the rescue again.
Yeah,
Yes.
It's pretty circular here. BlackRock said that they've already facilitated more than $3 billion of these transactions. Bitwise said they're getting calls basically every day for investors looking to do this. And sometimes it's someone looking to take all of their Bitcoin holdings and move it to the ETF. Sometimes it's someone just looking for maybe 20% of what they own.
Just 10 seconds. Why are the ETFs popular for this?
Because you can make this change, what we believe to be tax-free, because there's no selling involved. So you can kind of move into this ETF and you don't have to actually sell your Bitcoin holdings. You just kind of swap them.
And no capital gains taxes as a result. Bloomberg's Emily Grafeo, thank you so much. Be sure to read her latest story, BlackRock pulling Bitcoin whales into Wall Street's orbit. Now, another notch for TradFi?
Yeah, I think that's fair to say.
All right, maybe one for today, and we'll see what happens next week. That's all for Bloomberg Crypto. Please join us again next week. From New York, this is Bloomberg.